Tonight, I want you to forget everything you think you know about safe investing. Because when one of the most powerful institutions on Wall Street quietly trims a legendary giant like Amazon and redirects capital into an AI company that exploded over 1.0% in just 2 years, that is not a coincidence, it is a warning shot. This is how fortunes reposition before the crowd notices. This is where conviction replaces comfort, where data silences noise, and where the future starts leaving clues. Stay with me, because what you're about to hear is not speculation. It's how serious money moves when the world is about to change. Capital is never emotional. It is patient, disciplined, and relentlessly rational. When a firm reallocates billions, it is not reacting to headlines or narratives. It is responding to evidence. Selling a position in a company as dominant as Amazon is not a statement of doubt. It is a reflection of maturity in capital stewardship. Amazon remains an extraordinary business with scale, infrastructure, and embedded relevance in global commerce and cloud computing. But leadership in investing requires asking a harder question. Where does the next dollar work hardest from this point forward? Strategic reallocation is about recognizing asymmetry. Over time, even the most exceptional companies mature into predictable growth curves. Predictability is valuable, but it is rarely where outsized returns are born. Markets reward those who identify inflection points, early moments when technology, demand, and execution align to compress years of growth into a short window. Capital must move before consensus does, not after. That is the discipline that separates participation from performance. Selling millions of shares is not an exit from belief. It is an optimization of opportunity cost. Every dollar tied to one asset is a dollar not deployed elsewhere. In an environment defined by rapid advances in artificial intelligence, data infrastructure, and enterprise software, the opportunity set expands dramatically. The responsibility of capital is to flow toward the highest probability, adjusted returns, not to remain loyal to yesterday's winners simply because they were winners. This kind of decision is grounded in research, not instinct. It is driven by cash flow modeling, competitive positioning, scalability of technology, and the durability of demand. Artificial intelligence is not a trend. It is a structural transformation. Companies that sit at the intersection of data, decision making, and real-world deployment are not just improving efficiency. They are redefining how institutions operate. That redefinition creates leverage, and leverage creates exponential outcomes when executed correctly. Reallocation also reflects risk management. Concentration risk grows quietly when positions outperform for long periods. Trimming strength is not pessimism, it is prudence. It ensures flexibility, liquidity, and the ability to act decisively when rare opportunities emerge. The best investors are not those who predict the future perfectly, but those who prepare portfolios to benefit from multiple futures while avoiding catastrophic downside. There is also a psychological discipline at work. Markets punish attachment. When investors identify too closely with a position, they stop evaluating it objectively. Strategic selling enforces humility. It forces a reassessment of assumptions and keeps decision-making anchored in data rather than reputation or narrative comfort. That humility is essential in fast-moving technological cycles where leadership can shift faster than balance sheets reflect. Ultimately, reallocating capital from an established giant to a rapidly scaling innovator is a statement about time horizons. It signals confidence in the ability to identify where growth is accelerating, not where it has already been realized. It reflects an understanding that wealth is compounded not by standing still, but by moving deliberately, early, and with conviction when the evidence supports it. This is how capital stays ahead of the curve, quietly, decisively, and without apology. Extraordinary returns are never accidental. When a stock compounds more than tenfold in a short span of time, it is not driven by hype alone. It is driven by a fundamental shift in how value is created. The market does not reward ambition, it rewards execution at scale. In the case of a rapidly rising artificial intelligence company, the performance reflects something deeper than momentum. It reflects relevance. Relevance to governments, enterprises, defense systems, healthcare networks, and institutions that operate where precision and speed are non-negotiable. Artificial intelligence is often discussed as a consumer story, apps, assistants, and interfaces. But the real economic power of AI sits beneath the surface, embedded in data, integration, decision engines, and mission-critical infrastructure. Companies that solve complex problems for large organizations do not grow linearly. They grow as trust compounds. Once embedded, these platforms are difficult to replace. Switching costs rise, moats deepen, and long-term contracts create predictable revenue streams that markets eventually reprice aggressively. A stock that rises 1.000% in 2 years does so because the market is catching up to realities that were already forming. Early on, skepticism dominates. Analysts debate valuation, critics question sustainability, and volatility scares away impatient capital. But as revenue accelerates, margins expand, and use cases multiply, doubt erodes. At that point, valuation stops being a constraint and becomes a reflection of future optionality. The market begins pricing not what the company is, but what it can become. This is where disciplined capital allocation matters. Investing in such a company is not a bet on headlines. It is a bet on adoption curves. Artificial intelligence platforms that move from experimentation to deployment experience a sharp inflection in value. Pilots turn into enterprise-wide rollouts. Single, department tools become organizational backbones. That transition is rare, but when it happens, it compresses years of growth into quarters. What separates enduring AI companies from temporary winners is alignment with real-world demand. Algorithms alone are not enough. The winners integrate seamlessly with existing systems, enhance human decision-making, and deliver measurable outcomes. Institutions do not buy vision, they buy results. When an AI company proves it can improve efficiency, reduce risk, or create strategic advantage, spending becomes durable, even in uncertain macro environments. There is also a broader signal in such performance. Capital is repricing intelligence itself. Data is no longer passive, it is operational. The companies that transform data into action become indispensable. Markets reward indispensability with premium multiples because it creates pricing power and resilience. That is how extraordinary returns are sustained beyond the initial surge. At its core, a 1.0% rise is not about timing the market perfectly. It is about understanding transformation early. It is about recognizing when technology crosses from potential into necessity. Capital that identifies that moment and commits with conviction is not chasing returns. It is aligning with inevitability. And in markets, inevitability, when correctly identified, is the most powerful force of all. Markets don't move on stories, they move on signals. The most important signal is not what investors say, but what capital does. When capital rotates decisively, it reflects a change in conviction about where long-term value will compound most efficiently. This is especially true in moments of technological transition, when legacy strength and future dominance briefly coexist. The challenge is not identifying quality, it is identifying acceleration. Artificial intelligence has introduced a new competitive dynamic across industries. It is no longer a productivity enhancer on the margins. It is becoming the operating system of decision-making. Companies that harness AI to convert massive data sets into actionable intelligence gain an advantage that is structural, not cyclical. They don't just operate faster, they operate smarter. That difference compounds over time, and markets are ruthless in rewarding it. What separates durable AI platforms from speculative ventures is institutional adoption. When governments, defense agencies, healthcare systems, and global enterprises integrate a platform into their core workflows, it signals trust. Trust is the most valuable currency in technology. It lowers customer acquisition costs, extends contract duration, and creates recurring revenue that can be forecast with confidence. Markets may debate valuation in the short term, but they rarely misprice trust for long. There is also a misconception that rapid appreciation implies excess. In reality, rapid appreciation often reflects delayed recognition. Early in a company's evolution, uncertainty dominates pricing. As execution proves consistent and demand scales, the discount rate collapses. What looks like exuberance is often just the removal of doubt. The repricing happens quickly because markets are forward-looking by necessity. From a portfolio perspective, this is where judgment matters most. Allocating capital to accelerating platforms requires tolerance for volatility and a clear-eyed assessment of downside versus upside. The downside is usually tied to execution risk or adoption delays. The upside, however, is asymmetric. When a company becomes foundational infrastructure, it can expand across verticals, geographies, and use cases without proportional increases in cost. That is how operating leverage transforms strong businesses into extraordinary ones. Risk management does not mean avoiding bold decisions, it means understanding them fully. Diversification protects against ignorance, not insight. When evidence aligns, revenue growth, margin expansion, customer concentration improving rather than worsening, conviction becomes rational. At that point, hesitation is not prudence. It is opportunity cost. There is also a macro dimension. In an environment of tightening liquidity and higher capital costs, only companies with clear value propositions thrive. AI platforms that directly improve efficiency, reduce waste, or enhance strategic outcomes are not discretionary spend. They are priorities. That insulation from macro pressure increases their attractiveness relative to businesses dependent on consumer sentiment or cyclical demand. Ultimately, capital flows toward clarity of mission, clarity of execution, and clarity of relevance. The most powerful investments are not those that promise transformation someday, but those that are already transforming how institutions operate today. When capital recognizes that shift and acts decisively, it is not chasing performance. It is positioning for inevitability. And in markets, inevitability is where enduring returns are made. The most misunderstood concept in investing is conviction. Conviction is not stubbornness, and it is not loyalty to a familiar name. Conviction is the willingness to reassess facts continuously and act when the evidence changes. Markets are dynamic systems. What worked brilliantly 5 years ago may still be strong today, but strength alone does not justify inertia. Capital must remain mobile because opportunity never announces itself politely. In periods of technological disruption, the cost of standing still is often higher than the cost of being wrong. Artificial intelligence is compressing innovation cycles, collapsing timeframes that once took decades into a matter of years. Companies that adapt slowly may remain profitable, but they risk losing strategic relevance. Meanwhile, organizations that embed intelligence at the core of their operations can leapfrog incumbents with speed and precision. Capital flows toward that velocity. Rotating out of a successful position is one of the hardest decisions in finance. Human nature rewards familiarity and past success, but markets do not compensate nostalgia. They compensate for foresight. Trimming exposure to a mature leader is not a judgment on its future viability. It is an acknowledgement that growth rates normalize. As growth normalizes, return potential compresses. That compression is subtle, but over time it defines performance. The discipline lies in identifying where growth is not just strong, but accelerating. Acceleration is the key variable. It is driven by adoption curves, expanding use cases, and scalability that does not demand proportional capital investment. Artificial intelligence platforms that move from isolated deployments to enterprise-wide integration experience exactly this kind of acceleration. Each new client increases the value of the platform, not just its revenue. That creates network effects that traditional valuation models struggle to capture early. Risk, in this context, is often mischaracterized. Volatility is not risk, irrelevance is. A company that becomes embedded in mission-critical workflows can withstand market turbulence far better than one dependent on discretionary spending. When AI tools move from experimental budgets into core operating expenses, they become durable. That durability attracts long-term capital, which in turn stabilizes valuation over time. There is also a strategic patience required. Not every rotation pays off immediately. Short-term market reactions can be noisy, emotional, and disconnected from fundamentals. But capital allocated with a multi-year horizon does not need instant validation. It needs consistent execution. Over time, execution overwhelms skepticism. Revenue follows relevance, margins follow scale, and valuation follows inevitability. The broader lesson is that leadership in investing is about decision-making under uncertainty. Perfect information does not exist. What exists are probabilities informed by data, experience, and judgment. Acting on those probabilities decisively and without regret is what separates stewards of capital from spectators. Ultimately, markets reward those who recognize that progress does not follow a straight line. It moves in bursts, driven by technology, adoption, and human behavior. A capital that stays flexible, disciplined, and forward-looking will always find those bursts, and when it does, it compounds not just returns, but relevance in a world that refuses to stand still. At the highest level of investing, success is defined less by prediction and more by positioning. Markets will always surprise, narratives will always shift, and volatility will always test resolve. The role of capital is not to guess every outcome correctly, but to be positioned where change creates advantage rather than risk. That principle becomes critical when technology reshapes entire industries faster than traditional models can adapt. Artificial intelligence represents one of those moments. It is not a cycle that rises and falls with consumer sentiment. It is an infrastructure layer being woven into the global economy. Decisions, logistics, defense, healthcare, finance. These systems increasingly rely on intelligence that operates at machine speed. Companies that enable this shift are not vendors, they are partners in execution. That distinction matters because partners endure while products are replaced. Positioning capital towards such companies requires intellectual honesty. It means acknowledging when yesterday's growth drivers are no longer tomorrow's accelerants. Even exceptional businesses eventually transition from expansion to optimization. Optimization is valuable, but it rarely delivers exponential returns. Exponential returns come from transformation, when technology unlocks entirely new ways of operating and creates demand that did not previously exist. This is where long-term vision separates noise from signal. Short-term price movements reflect emotion, long-term value reflects adoption. When institutions commit to a platform and restructure workflows around it, they are making a multi-year decision. That commitment translates into recurring revenue, predictable cash flows, and expanding margins as scale improves. Markets eventually recognize this durability, but only after it becomes undeniable. There is also a cultural element that is often overlooked. The most successful technology platforms are built by organizations that understand the environments they serve. They are designed not just by engineers, but by people who understand complexity, regulation, and real-world constraints. That understanding allows them to solve problems others avoid. Solving challenging problems fosters loyalty, and loyalty in turn creates longevity. From a capital allocation standpoint, this longevity reduces uncertainty. It allows investors to model outcomes with greater confidence and commit capital accordingly. Confidence, when grounded in evidence, is not arrogance. It is efficiency. It allows capital to concentrate where it can be most productive rather than dispersing defensively. Importantly, this approach does not reject diversification. It redefines it. True diversification is not owning many names. It is owning businesses exposed to different growth drivers and structural tailwinds. Artificial intelligence, when embedded deeply, becomes a tailwind that transcends cycles. It improves efficiency in downturns and accelerates growth in expansions. That dual benefit is rare and valuable. Ultimately, markets reward alignment with progress. Capital that aligns early remains disciplined and adjusts as facts evolve will outperform capital that clings to familiarity. The future does not belong to those who wait for certainty. It belongs to those who act when probability favors transformation. In investing, as in leadership, progress is rarely comfortable, but it is always decisive. So as the noise fades and the headlines move on, remember this: the most important decisions in markets are never made on camera. They're made quietly, decisively, and far ahead of consensus. When capital walks away from comfort and steps into conviction, it's signaling where the next chapter of wealth is being written. The question isn't whether artificial intelligence will reshape the world. That's already happening. The real question is this: will you recognize the signal, or will you notice it only after the opportunity has passed? Because by the time everyone agrees, the move is already over.